Welcome back, my friends. Well, one of the biggest and most important earnings just came out, namely Google. And, if you follow this channel, you probably expected a disappointing report. And, that is exactly what we heard. Google revenue growth slowed to 6% as compared to 41% in Q3 of 2021. That is an amazing slowdown and puts Google in line with a lot of old economy companies. So, we really need to ask ourselves, what is the real future of Google? Remember, share prices of Google and a lot of other tech companies are based on the expectation of astronomical growth. So, if that growth has slowed to pretty much pedestrian rates or even gone negative, what does it mean? Shares of Google parent Alphabet 8% Wednesday, which was the first trading session after the report. We will see where things go from here. I think that, from now on, every quarter will be a new experience, especially for big tech. As you all know, consumers are tightening up their wallets. Corporate marketers have cut their ad budgets, especially for online ads. And, if you follow this channel, you know that online ads are the lifeblood for many big tech companies. Google is now having to contend with a continued and pronounced downdraft in online ad spending. This has never happened before. Is it a sign of the future? Or, will growth get back on track when fears of a recession subside? What does it mean for big tech companies? What does it mean for the economy? And, what does it mean for the future of the United States? But, before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Shares of Google parent Alphabet fell more than 6% Wednesday after Google's weak earnings call. This comes after Google shares have fallen more than 30% this year prior to yesterday's call. For Google, Q3 earnings missed on the top and bottom lines. That means that total revenue came in lower than expected and so did profits. Overall advertising revenue for Google was $54.48 billion in Q3. That was just a little higher than in Q3 of 2021. Wall Street analysts projected a rise of 3% in YouTube ad revenue. But, instead, YouTube revenue actually decreased by 2% from the same quarter last year. Specifically, YouTube ad revenue was $7.07 billion versus $7.21 billion a year ago. One investment bank, Bernstein, maintained their outperform rating on Alphabet stock. As Google's ad revenues decelerate, the company has become increasingly uncomfortable over the last 6 months, said Bernstein. So, you have to really wonder what they really mean when they say, outperform. We could be witnessing the maturation of the online ad market. Google is an ad business first, and digital ads is no longer a safe place to hide, Bernstein said Wednesday. The outperform rating was also maintained by Raymond James analysts. We expect long-term ad revenue growth and Google Cloud momentum, said Raymond James. Alphabet plans to slow headcount additions, so we are optimistic that margins can improve by later 2023, said Raymond James. Well, friends, to me, that does not sound like a ringing endorsement of growth. Rather, it sounds as though these analysts are anticipating that Google will cut employees in order to improve profits. So, fairly meager revenue growth, combined with job cuts equates to better earnings per share. Of course, that is how Wall Street is going to look at a situation like this. The question is, can Google and its employee base deal with the shock of Google just becoming another slow-growing, big company? And, I think that is really the underlying theme these days as central banks all over the world take the punch bowl away from the party. The past 15 years have been something of a low-interest phenomenon time period. But, interest rates of around 1% are not really normal, nor are they sustainable. I think that we are now entering a period of sustained higher interest rates. Interest rates might actually go higher than they stay. But they will stay higher than they have typically been for the past 15 years or so. And it is not as if there has been or will be no fundamental economic drivers. It is fair to say that Google has been one of the biggest and most innovative economic catalysts of its time. But, we can only live so long on the fumes of innovations that are, frankly, getting a little long in the tooth. The same could be said about Apple. In many ways, Steve Jobs and the iPhone bailed the world economy out of the Great Recession. But that was almost 15 years ago. And in a highly technological world, it is ancient history by now. It is time for something new, whatever the next big thing is going to be. Google's earnings call kicked off an ominous start to a week of big tech earnings. Meta reports today after the close of the markets. And let me tell you, my friends, I think that you should be sitting down when you listen to Meta's earnings call. Analysts at Needham have already said that if Google's call is bad, Meta's will be worse. And Meta has already reported 2 consecutive quarters of declining revenue. They are also losing a ton of money investing in the metaverse. So, today there is likely bad news from Meta. In its call, Google CEO Sundar Pichai discussed more hardware spending in the future. Same with Meta, of course. You all know that Meta is betting big on virtual reality headsets. But, with higher spending on hardware comes lower return on invested capital. This is a fundamental change from when Google was predominantly a software and advertising biz, said Raymond James in a Wednesday note. And, if you follow this channel, you probably already know that tech companies are experiencing weak macroeconomic conditions. Google and Meta platforms reported decidedly disappointing Q2 earnings. Meta has begun quietly pushing out a significant number of employees. Meta is trying to cut costs by at least 15% by the end of the year. These days, employees with good reputations and strong performance reviews are being routinely fired. Meta has about 83,000 employees, which is 32% higher than at this time last year. Google has 174,000 employees, which is 20% higher than this time last year. But the United States is now teetering on the brink of recession and the digital ad market has plunged. Shares in Meta platforms are down by over 50% so far this year. And the market capitalization of Meta has fallen by over $685 billion since its all-time peak in September 2021. The market capitalization of Google is down 27% over the past 122 months. Speaking at the Vox Code Conference, Mr. Pichai said that Google needs to be 20% more productive. Although he did not give details on exactly how that would be done. But not all big tech companies are adopting the stealth layoff approach like Google and Meta. Snap has publicly announced layoffs of 20% of its employees. This comes after Snap grew its headcount by 65% within the past year and a half. This year, it is clear that Wall Street analysts are valuing profitability over prospective growth. As a result, unprofitable tech companies' shares are getting punished. And all companies are forced to either be profitable, find a merge partner, or die. The window for initial public offerings is effectively closed. That is why some Wall Street investment bankers are predicting a wave of tech mergers later this year. Twilio, another unprofitable tech company, is pretty much in the same boat as Compass. Last week, Twilio announced the layoff of 11% of its employees in a broad financial restructuring. Apple announced that it is cutting 100 positions and slowing hiring and spending. Oracle, the worldwide software giant, has cut hundreds of positions but declined to say how many. Crypto lender Genesis cut 20% of its workforce due to what they call turbulence in the cryptocurrency market. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.